Um, Good morning, everyone. My distinguished panel speakers would be pleased to share their thoughts on various risks facing the unit trust, PRS, and fund management industry, as seen from different perspectives. Amidst the COVID-19 pandemic, customers seem to embrace digital distribution channels faster than expected. This panel would therefore like to explore the risks of digitalization to the unit trust and PRS industry, which currently rely heavily upon the human touch to distribute unit trust and PRS products. As we have a large number of unit trust and PRS consultants in the audience this morning, I would like to pose this question to my first panel speaker, Ms. Ng Su Yan, who among her other titles is Innovation Partner of Ernst & Young Malaysia. So Su-Yan, what is the risk of technology like AI and robots replacing the human unit trust and PRS consultants? Also, in your view, what part of business operations have been most impacted by technology?
Thank you, Ms. Yon. Well, in this sector, technology has been changing the way things are being done way before the pandemic. We have seen the wealth manager launch the service allowing clients to open accounts using teleconferencing. Others use technology from electronic signatures and online ID verification to biometric authentication. There are now tablet apps to support consultants in client meetings by guiding them through a smart, adaptive, and interactive sales process, consolidating all relevant sales functions in a single platform. And there are also apps that perform personalized health checks that identify potential issues with personal portfolios, offering tailored remedies to bring the health status back to desired levels. So in the last 1.5 years though, most of us have had to adapt to new ways of working, learning, socializing, and even shopping. Not that these new ways were not previously available. Most of us just preferred or stuck to the traditional options. And now, 1.5 years later, are we not itching to go out and shop and socialize like how we did previously? So while investors seem to have adapted very quickly to digital distribution channels, does it mean that there's no more room for consultants? Like most other businesses, not surprisingly, the younger generation is more likely to consider changing the way they do things. So I'm going to use Robo Offerings, for example. In one EY Global survey, it was found that 61% of those between the ages of 18 and 34 are likely to consider robo-advisors, compared to 51% between the ages of 35 and 50. But this drops further to 24% if you look at those between the ages of 51 and 71. Right? So you can see that change as based on ages. Now, having said that, what we have done in the last 1.5 years is mostly migrating a long-established relationship from the physical to the virtual world. But if you want to build a sustainable digital connection with new investors, or even introducing new products to existing investors, that would be harder. A study conducted by Microsoft indicates that people generally start to lose concentration after about 8 seconds. Right? So how do you create a connection virtually with investors in that short span of time before they lose interest? So what fund managers need is a client-centric digital distribution strategy that provides an engaging experience. And this very likely is going to balance technology with human interactions according to investor preference. And so, of course, the role of the consultant will fit into that strategy, and this may differ from fund manager to fund manager. Some things, we always say, think about when it comes to client experience. What services are most meaningful and attractive to your target clients? And this is where client segmentation can be used as a strategy driver. By segmenting customers by their risk tolerance, for example, training and educational materials to consultants serving the specific segments can be adjusted. There can be behavioral matching of consultants and potential clients. And there's also a study showing that different investors prefer different levels of interaction at different phases of the sales cycle. So at the end of the day, the answer to your question, right, is there a role for consultants to play moving forward? The answer is, it depends, because it very much depends on which clients the fund manager has identified to serve. So to your second question, we know margins have been squeezed in this industry for years due to competition, due to increased cost of compliance. And we've seen technology being adopted to improve efficiency, accuracy, and value. In fact, one study by EY indicates that the cost reduction for a medium-sized asset management firm can be up to 15% by taking action on strategic cost transformation. As the most basic, technology was used to automate repetitive operational activities, freeing up individuals to focus on activities that bring about competitive advantages. And that really covers the whole middle to back office value chain, everything from achieving straight-through processing to improving the integration of platforms, automating reconciliations, creating marketing materials, etc. But the paced adoption of technology has been going on for quite some time now. So perhaps a more interesting question to ask, what function tends to be a late adopter of technology? And it might be surprising to some, because as it turns out, it's usually the compliance function. And unlike other operational costs, those associated with compliance tend to scale in line with the business. Compliance function is affected by manual processes across other functions, ineffective coordination among siloed business units, outdated policies, and increasingly customized IMAs as investors becomes more demanding. And as if that's not enough, regulators need to make financial penalties large enough to disincentivize violations. But we are starting to see adoption of emerging technologies in compliance. For example, the use of workflow automation tools to help with end-to-end client onboarding. Also, the use of natural language processing and machine learning to read IMAs, prospectuses, and extract guidelines. In fact, EY recently developed an automated compliance rule processing tool for clients, which extracts compliance rules from reading investment management agreements into structured, rationalized data sets. But whatever the function may be, identifying the right tools is key to making the most of technology. And perhaps the disruption caused by the pandemic will give fund managers a chance to revisit and redefine their future of work. At one level, this can support cost transformation. For example, if you reassess the value of business travel and delivering more learning and coaching remotely. At another level, these savings then could be channeled to fund required investments in technology, data, and upskilling of talent. Because of course, technology can be very expensive, right? So then there's a question of, do you buy, do you build, do you partner? That's a totally whole different area.
Thank you very much, Lynn. That was very illuminating. So we can see that for all you unit trust consultants and PRS consultants out there, it depends, all right? You have to watch it. You may be taken over by robo-advisors and robots. So watch this, learn to how you can embrace technology and digitization to ensure your industry will still carry forward. Right, moving on, I would like to now let you know, right, other than digitization, the pandemic had brought about the realization that there are different ways to do business. We can work remotely, we can communicate effectively via Zoom, we can do many things differently and help reduce CO2 emissions. We also saw multiple climate records broken this year, when Canada suffered its hottest temperature ever of 49.5 degrees, killing many from heat stroke. We saw massive flooding in Europe, which killed hundreds in that very developed region. The United Nations climate report in August had labeled Earth a code red for humanity. Since we all know money makes the world go round, and money also contributes to planet Earth burning up fossil fuel, I would like to ask my second panel speaker, Ms. Sally Wong, who is eminently qualified to give us an international perspective to the questions. Why are climate-related and ESG risks important to the fund management industry? Also, what are the fund management companies doing to manage this risk? Sally?
Thank you very much. In fact, it's a great pleasure for me to join all of you here. Maybe a little bit background about the Hong Kong Investment Funds Association. Even though we are called Hong Kong, in fact, our membership is much broader than Hong Kong. In fact, probably I would say the vast majority of our members are global firms because Hong Kong itself is quite a small market and local, really Hong Kong-based firms, I would say, in the minority rather than the norm. So when we discuss a lot of these issues, our perspective is more from a global, from an international perspective. And on the topic of ESG, probably this is something that is high on the agenda of the asset management industry. Just follow up on what the earlier discussion about this code red for humanity. In fact, there are a few quotes that I hope to set the scene for the discussion. Why everyone is homing in and focused so much on ESG. I quote from the report. The world is likely to be 1.5 degrees Celsius warmer than pre-industrial levels in just 20 years, even with deep cuts to greenhouse gas emissions. And then, if you look at what G7, they have been focusing on, they pledged that in May this year to limit warming to 1.5 degrees Celsius in a shift from the 2015 Paris Accord headline goal of keeping temperature at well below 2 degrees Celsius. So this whole topic has elevated to the national and the international level. And why is it so important? Because it primarily relates to existential, post-existential threat to mankind. And you can see a lot of regulators, an international one, for example, FSB, IOSCO, they're looking into this because the implications have major financial risk implications. So I think at the financial service sector, we are not just looking this from in terms of opportunities, the return side, but more importantly, something basic from risk management perspective. And you can see that IOSCO, FSB, they're working a lot on, like say, liaising to develop frameworks to see how to manage the whole thing. One key initiative, of course, is the TCFD, the whole infrastructure, the governance, the reporting, the disclosure, the risk management. And that set a very important framework globally for industry participants to navigate this whole subject. And on top of that, FSB and IOSCO and IFRS, they are also working on developing a global framework alongside the International Accounting Standard Framework. They want to develop this International Sustainability Board framework so as to ensure that there will consistency, reliability, and comparability of data. Because currently, a major challenge for the industry is that there's the lack of data. Or you can say there's a lot of data, but they're not really comparable. And they come in all sorts of forms. There are different ratings, scores, and everything. So to address this issue, to really ensure that the industry can really use the data, what we need is to start from a basic foundation. That is for listed companies, for issuers, to come up with data that fund managers, asset owners can use. And this framework, this international framework, this international coordination is very important. And this is one area. And then another area is that at the asset manager level, you can see that there's a lot of new requirement on disclosure, on governance, on reporting. And this is something that I think going forward, all asset managers should be geared up for. The matter is not whether they will be coming. They will definitely come. But it's how you manage this. And for example, in Hong Kong, we have disclosure requirements on, like, say, ESG-related funds. We have disclosure requirement in relation to the code of conduct. So all these are coming in. So for asset managers, the key issue is in terms of structure, in terms of governance, how can you set from a tone from the top? That is at the board level, how do you have this oversight to ensure that ESG factors are really integrated into the whole company culture, into the investment process, into the risk management process? So a key message is that it is not something nice to have. It's not something niche. It's coming into mainstream. And we have to prepare for this. Thank you.
Thank you very much, Sally. That was very interesting. So there's a message there. All right, everybody, look, the ESG risk, the climate related matters, right, is actually at our doorsteps now there. We have to be prepared. These are coming, whether you like it or not, right? Now, the pandemic also impacted certain sectors of the economy in ways never experienced before. For example, international borders closed. This caused a huge impact to all those involved in the aviation and tourism industries. Chip manufacturing companies, they were closed because their workers had got infected with the COVID-19. This caused a huge global shortage of chips, which impacted the motor industry, right? So, yet, what we saw was the equity markets had performed very well, not just in Malaysia, but in major markets globally, despite the pandemic. So for my next question, we are honored to have a very distinguished speaker, Dr. Tan, whose 45 years experience has seen him through the worst global crisis. Dr. Tan, would you say that there are no more investment risks now that many people in the developed world and emerging markets have been vaccinated and economies around the world are reopening, including in Malaysia? How do you mitigate volatility in the equity markets and outperform in the long run? Dr. Tan? Dr. Tan, you're on mute. Okay, sorry. Dr. Tan? Dr. Tan, we can't hear you. Yeah.
Now. Okay, sorry.
Okay.
I'm muting now. Okay. Yeah, okay. It's a very good question. It's a very good question. And I think I can answer these two questions all in one, actually. First, it's very important. I think the market is not efficient. People always look for a formula to think that you can get one formula and apply for all, but that's not the case. There are always so many factors, and then since this is a cause for risk, we can talk about the risk a little bit. When you go into the market, you take risk, and you have to deal with this risk because the market is not efficient. All these risks, they come in at a different time. For example, you are facing this situation which is very, very unique. Last year, actually, if you look at 2019 was a very good year. And at the beginning of 2020, US went up even further. And that is actually looking for trouble. So if you have a philosophy and you practice value investing, and I think if you get out at the beginning of that last year, and then when the market crashed, you take the concept that the crisis is an opportunity, and then you go back and buy again. In fact, that's what we did last year, and every of our accounts in Malaysia outperformed. So that makes us very, very distinct. So what I'm trying to say is that you have to remember two things. The market is not efficient, and then value investing at times in the long run it works. So I feel that when you see a situation like that, but although you say that last year was a very unique case, the market went to the record high, and if you think it's too high, you sell, and then you go back, and then suddenly they say economy is definitely going to slow down last year, which everybody will accept. Economy will slow down. And make it worse, pandemic came, and they will say, wow, this is the worst crisis you ever see in your lifetime. Many people say that. But actually, you take the other way around and take a longer term view and say crisis is an opportunity. You need to watch the share prices. It's the price that counts. If the price was so cheap and you are willing to take a longer term, you will do well. In fact, if you compare last year versus global financial crisis, it's quite the same. When the crisis came, it come down, and then you will recover. Then tell me which stock market don't recover in the long run. The inflation itself will bring it up. So that's what sounds complicated, but now that you say market is not efficient, market is not logical, then not all share will drop at the same time. Some sector will do well. That is what happened last year. Some sector did well. So what we did is that we say, you must adapt your strategy to the environment changes. Now, you look at last year in Malaysia. Rubber glove went up, big time. In fact, it's very interesting, you know. Some rubber glove share within 5 months went up 12 times, you know. And then you say, what happened last year? Economy is bad, you know. US is crashing, you know. We are also affected. So that show that. But saying that, because there's a great demand for rubber glove, they get so desperate, they beat it up. The average selling price go up 3 times, and the profit go up maybe 5 times, you know. So they just drive it up. But if you practice value investing, you notice that the share has run up so fast, you know. Can you believe one of them run up within next 5 months, from maybe April to August, went up 12 times. So you can't believe that this share is going to continue to run. If you sell it off, you will do very well. And then while other shares are running, this share actually, after hitting such an abnormal high price, it crashed down. So the people who invest in rubber glove sell at a high point and then actually go to another sector will do very well. Similarly, you look at the tech stock last year. The tech stock last year also goes so wild, you know. So the tech stock are doing well. The rubber gloves are doing well. Some of the software company also doing well. So then now you're going to see what happened now. Yeah, despite pandemic comes in, despite more people get into very bad shape, it's only sectorial. Your hotel, your so-called hospitality, and all the people related in tourist industry is actually affected very badly. Beverage, you know, hotel, restaurants are affected very badly. So that's what I'm trying to say, that you need to adapt to the environment. There are plenty actually sector that has actually done well, you know. Yeah, for example, if I put on the list, the 5G is doing very well. In fact, even Inari, even all these semiconductors are doing very well. Although you say there's a shortage, but when you have a shortage, they come with a better price. So the guy also may make more money. So you need to go and analyze. Then if the company that can pandemic problem, got labor problem, got financial problem, they have problem, you know. So to summarize it, we are very optimistic. We tend to think that if they are too expensive, we sell. When they are not expensive and they have growth, we should think about it. But you need to analyze. That's the answer. Now, you look at from now onwards, I think 5G is still very hot. Renewable energy, definitely very hot, because everybody is talking about ESG. So you need to go and spend time on that. You need to spend time on solar, on wind, on hydroelectric power, you know. But you also notice that with the pandemic, your e-commerce are doing well, your e-learning are doing well, but not all these companies doing well are selling to you at a cheap price. Sometimes they already run far ahead. So you need to take into consideration of the price also. So electric car is hot, battery is hot, software is hot, cyber security is hot, digitization is hot, security, supply chains. But now, because of the inflation, people are also skewed towards old economy again, you know. So you see that the nickel price is doing well, tungsten price is doing well, so commodity is getting hot again. So I'm not so pessimistic. It's just that you need to analyze and go and study them, you know. And by all means, with climate change, for all you know, you look at the palm oil price. The palm oil price is record high, and the share price is not performing well, but you don't know, you know. It may be so cheap, you should be thinking about doing that, you know. So we say we have a lot of options. This opening up may change things again, you know. So you need to analyze. So ending story is that the market is not efficient. You need to analyze, and you can be very optimistic, you know, to make more money. Because with the inflation, I think some sector will continue to do well. Yeah. So have I missed anything? Have I answered your 2 questions?
All right. Okay. Thank you, Dr. Tan. Thank you very much. That was very illuminating. That was certainly exciting, right? Value investing seems to be the message that you are asking everyone to consider. Don't just invest blindly. Do some research. Do your homework. All right. Look at value investing.
But I must caution.
Yes.
Can I just make the final point? How many more minutes I have? 1 more minute.
You have more than that. You can go ahead.
Okay. So you see, while we were saying that, actually US, if you believe US is going to affect us, US is actually trading at a very high market. You know, if you listen to the YouTube, Warren Buffett will tell you it's very high. You know, Dalio will tell you very high. You know, and many people will tell you very high, which is true. The market PE of USA is actually record high, although it's adjusting a bit. It's coming down slightly, but it's record high. You know, interest rate is almost record low, although it has gone up slightly, but it's still very low. Your 10-year yield is only 1.6%. At one time, it was only 1.2%. Your earning growth is slowing down, and your property price is at record high. In fact, actually, if you believe in that, then you'll be very cautious. The market is very high, and if US is going to affect us, the only answer you can give is that Asia has adjusted. Asia has not performed that well. So will Asia be doing better? But if you use the history, if Dow Jones is going to correct it, we will also affect. That is also a very good opportunity. Now, what is your strategy? Your strategy, you should raise cash because you don't know where's the highest point, right? But you know it's high. But when you wait until the market crash, it's too late. So if you want to take a safer bet, you raise your cash. So you have some cash, right? When the market tank, you have some money to buy. That's what I did last year. That's what we did. Already, sorry, I shouldn't say I, you know. I have a team. Yeah. So it's a very dynamic situation, but you need to know how to adjust it. You know, with the ESG. But saying that, you know, all these solar company, they get so excited, they beat the price up so high, you also need to be careful. You know, just the same as rubber glove. You know, what you say is correct now. One of the tech stock in Penang, actually within 1.5 years go up 22 times, my friend. That is nuts, you know, actually. So it's not logical, but if you have one of these, you know, so if I were to tell you a bit more, so I sold the rubber glove shares. So I went to buy one of the enabler company in Indonesia in November, end of last year. And that share went up 16 times, you know. So you can't be so pessimistic either. It's whether you know how to go and find them. Okay, I should stop here.
Thank you for the
I'm too optimistic, maybe.
Yes. I don't know. I think what you're saying is that it doesn't matter. There's always a time to buy. All right. There's always a time and stocks which are a value that you can find, and therefore there's no time. Even though it's overheated, there'll be some that's doing all right. That's the potential to go up. Okay. Now I'd like to just tell the audience and invite them to please post questions. I think there's a Slido function available to you. So if you can post questions to any of our speakers, please do so now, because we will open up to Q&A. And in between, whilst we wait for your questions to come through, let me just go back to Suen, right, and talk a little bit more about digital and digitization and risk, right? So now that, I mean, digital is always a huge cost, right? So what do you think businesses should do? Should they buy, or should they just build it, or what do you suggest?
I think when we see what successful fund managers who have adopted or migrated to a digital strategy, right? What they always start with is to look at their digital blueprint, and to have a digital goal in mind. What is success through each of these? And digital, you don't adopt technology for the sake of it. not because it's sexy, not because everyone out there is doing it, right? But what does digital success means to this particular fund manager? Does it mean getting a better reach of clients? Does it mean being more efficient in the delivery? So identifying what exactly is your goal or your target, then finding out what is the right tools, who are the right partners, that would make more sense. The danger, of course, is technology is expensive, right? Even though right now things are a lot more sophisticated than what it used to be, it still doesn't come cheap. And what we find is that sometimes fund managers will adopt a very siloed approach in looking at technology. Something for the front office perhaps, and later on something for the back office perhaps. But the problem is when you start looking at things in silo, while yes, you can manage, the technology costs, and if something doesn't work, it's confined. The problem is then you have got these different pieces that might not talk to each other. They might not be bringing you towards the same goal that you want to achieve. So it's always important to start with the goal. What is digital success to the organization first, and then working out what is it that are available options. And of course, the build, the buy, build, or partner, those are options available to be considered once you've figured out what's your goal.
Right. Thank you, Suyan. Yes, I think goal is definitely clear, right? Something that has to be at the forefront before any investments in technology, right? Just going to Sally, because she had quite a lot of interesting things to share. And one of the things that you had discussed before was liquidity risk. Maybe, Sally, would you like to talk about that? Because that's a different angle, right, from the previous discussions.
Yeah. Thank you very much. On liquidity risk, I think in the past 2 years, and especially last March, the dash for cash situation, that a lot of fund companies have to grapple with redemptions. And especially for certain sectors, for example, high-yield bonds, emerging market bonds, and in the US and Europe, probably money market funds. So this raised a question about how do fund houses manage the liquidity matching between this obligation to meet redemptions on a daily basis. But in your portfolio, some of your assets may not be liquidated very timely. For example, if it's a fund, there may be a certain allocation, even though it's not very high, that may not readily be disposed of. For example, high yield in emerging markets. When everyone scrambles for the door, you can find the spread just shoot up. So I think the whole issue, the whole incident last March and the volatility of the market brings to the industry as well as the regulators, not just the national regulator, but the international one, about whether and to what extent will these non-bank financial institutions, in particular investment funds, since it's grown to such a large size, to what extent will that pose systemic risk? So I think the regulators have been approaching this more, not just at the micro level, but the macro level. At the micro level is investor protection. How do you meet the obligation to meet investor demand for redemption? Especially all these funds are supposed to be on daily liquidity. And then on a more macro basis, if, for example, emerging markets or high yields, if there's a massive redemption, how would that affect the local economy? And for these emerging markets, how do they manage all these inflow and outflows? So I think this has triggered off discussions. But one thing important is that, in fact, in the past 16 months, 18 months experience, it just demonstrates that the investment fund industry is very resilient. The whole framework is very robust. Of course, there's definitely room for improvement. But in terms of liquidity management, we can see there are a whole host of tools before and after to manage all these redemptions requests and inflow and outflow. Prior to setting up a fund, when you design a fund, when you come up with how to structure that, you have to consider a lot of factors to manage the future redemption request. And for example, in terms of the investor profile, in terms of the asset class, all these you have to factor in. And then, of course, post setting up the fund, are there any other tools that you can use, for example, in terms of swing pricing, redemption gates, and so on and so forth? So I think what the past 18 months tell us is that the investment fund industry have factored in liquidity risk very thoroughly into the whole design process. But definitely, there are rooms that we hope to work more closely with the regulators to bolster up, to ensure that at the micro and the macro level, we can really best serve the needs of the investors and really can help to serve as an important intermediation tool to help a lot of this economy, to contribute to the real economy.
Thank you, Sally. That was a very interesting answer. I would like to pose this question to Dr. Tan. The questions are coming in, right? And Dr. Tan, what is the most, in your view, what is the most overrated risk during this pandemic? That's an interesting one.
One of the most overrated risks. I think people are a bit too optimistic at times. I find, they drive shares up to very high price. That's, I think, you need to be a bit more careful. But sometimes when you see a high price, it get higher. So you also very hard to, value is in your eyes, Value is not something that, why would some share sell at 100 PE and the other share sell at 3 PE? So that's interesting. Then we said, investment is an art. I think people should always track, at times the market goes so wild, it can get so high. And if you don't want to take that kind of risk, then you get out. But you should be able to get out. We always emphasize that the people who know how to take advantage of the peak and the trough, in the long run, you will benefit the most. That's why if you look at some of our fund that has more than 25 years track record, we outperform by a very, very big margin. We outperform by a few 100%. So you must know how to look at it. Like at the moment, you can see, I don't think US is cheap. At the most, they can run around. They go from one sector to another. That will be beautiful. Then it won't have a sharp crash. Even that, you take a look at last year. Last year, actually, it always comes with a very strong market before it crashed. Actually, investor got a chance to get out. It's whether you want to get out or not. Last year, you can remember 2019 was doing very well. But January, February, they pushed the market up very sharply. And then it crashed, and it dropped 38.4% within 5.5 weeks. That is very sharp drop. Do you know that global financial crisis for 1 year and 5 months is only dropped 54%, and this one 5.5 weeks, 38.4% in Dow Jones. That is very, very sharp, So we think that is really a good opportunity, because when the index dropped 38.4%. We also follow them. Many of our shares actually dropped 60, 70, 80%. That is really, really an opportunity. But not that because it dropped is an opportunity. You need to find out that how's your financial position, how's the management of the company, where is the sector, is it going to recover? And that's the fund manager's job, That's why we can last so long. Our company is now 28 years old. So I don't know whether I answer your question. Is there anything?
It was on about the overrating of what risk was overrated, but never mind. We've got a question for Su Yan. So the anonymous question audience asks, adoption of technology comes with risk associated with it. How do we address this? All right, obviously, technology is not It's not something people embrace easily. Technology is very expensive. Technology may fail, right? So how do you suggest people address this?
Well, the biggest risk, in fact, is not so much that it will fail, actually. I mean, if you put in 2 million and it doesn't work, you lose 2 million, right? The biggest problem is that you adopt something, and because of what you have adopted, you may be open to, let's say, cyber attacks. And then, let's say, for example, in Malaysia, we have got a recent case, right? An app that most of us have on our phones was issuing unauthorized OTPs to the users. So if something like that happened, right, in the app that you have designed, it's not just losing money, it's reputational risk as well. You may be losing more than just what you've put in. So that's a very good question, actually, because we see that cybersecurity concern is very real right now across the different sectors. The more tools, applications, or online systems that you have, the more prone you are going to be to cyber attacks. And spending money to protect yourself against cyber attacks, how much is enough? Because obviously, it is something that you don't want to happen, right? You don't want other people to attack you. And you hope that you will not be a target. So do you spend X amount, Y amount, Z amount? How much is enough? There was one recent study that we did as well. And what we found was that across the globe, the chief investment technology officers.
So then you're breaking up a bit.
Yeah.
Sorry.
Technology.
Technology.
Okay.
Technology.
So this is one of those failings of technologies.
Maybe I can supplement a little bit about technology to chip in to share, because on technology, I think there are other dimensions. One is that we've seen more and more firms relying on third parties to provide technology support. Another aspect is about cloud computing. And I think all these also poses new challenges. Oh, Suyen is coming back. So I can pass it back.
I'm so sorry. So where did I drop off? So sorry.
Where did you drop off? About 2 minutes ago. Okay.
Please go ahead.
Yeah. So I was just saying, I think that the cost of investing in systems to protect the organization against cyber attacks, the key question is how much do you spend? How much is enough, right? Because when there is a successful attack, the price can be very costly. At the same time, if this organization has never been attacked before or yet, when the chief information technology officer recommends, let's say, spending X amount, the question that normally the boards will come back and ask, because they are being responsible boards after all, is, are we spending too much? Is this the right amount? Because, a dollar spent on this is a dollar not spent somewhere else. So that is the biggest challenge now. How much is enough?
That is that's the risk, of not spending enough, actually.
Yes.
Right? Yeah.
Yes, actually, yes.
Right. All right, Sally, thanks very much for dripping in, but I've got an interesting question for you too. So Sue is asking, if, right, maybe one of the fund managers could go back in time with the benefit of hindsight, right, what single one risk, right, would be addressed? Now that you know, right, what's happened with the COVID pandemic, right, and if you had the benefit of hindsight, what that one risk that people would have been addressed or would have addressed? Yeah.
I think for risk, it is probably not really appropriate to look at risk on a standalone and silo basis, because all these risks are interrelated. And what is important is really, from a firm's perspective, if we really want to have a robust risk management, it's really the board oversight, the management oversight, the tone set at the top. I think that is the most important. It's not just tick the box. You can have different lines of defense, the first, the second, and third. On paper, everything looks fine. But it's whether it's really well tested And you have to get prepared in good days, not just wait for when something happens. And I think the crisis really shows that for those who are well prepared from the top, I think those are most robust. And they, in fact, emerge from the industry, from the whole crisis, much better. If you look at the flows globally into the asset management industry, in fact, probably a lot of people staying at home have more time to look at their finance. In fact, asset management has been doing pretty well. And it's how you capitalize and leverage on these opportunities, not just in terms of products, not just in terms of the services, but in general, how do you manage the risk so that it can be BAU under all these sort of environment. I think that is most important.
Thank you, Sally, for your insight. Yeah, I think we probably have time for one last question. And maybe Dr. Tan, I think the audience probably listened to all your site insights, right? So the question posed is, seems like there's a lot of bad things happening, like China, there's a regulatory crackdown, there's energy crisis in Europe, in fact in China also right now, hyperinflation fears, right? How do we manage all this major simultaneous risk? So it's not just one risk, it's risk happening everywhere around the world and crisis. So Dr. Tan?
Okay, it's a good question. I think these are all the problems that we are facing now. I think the key is that, I can only say that you need to analyze them because, as I mentioned earlier, the market is not efficient and you will go from one place to another. Now people are more knowledgeable. People will go to the area that will grow as long as the price is still reasonable. People are still looking very hard to find new emerging star. You'll be surprised, country like in Indonesia, Malaysia, Philippines, they all have an emerging star. So if you can get one of them, then that's very good, So that's I think your inflation problem. I think your inflation problem will continue because the way U.S. stimulus, if you heard the story that 40% of their money supply was printed within the last 15 months, and that will scare you. So that will definitely have inflation. U.S. inflation for the last 5 months already more than 5%. But I see the commodity price going up. I see the weather change. I see the agriculture also facing problem. And then you will some inflation. But the fact that the whole world are stimulating at the same time, which I think we will read it right. They will not do the way in the 30s. Where they choke the industry, and they got more control, Whereas now we read it right in the sense that I feel that the whole world will stimulate. Then the whole world will stimulate, your inflation will come. Plus, if you are short of labor, you also have more problems, But hoping that it will adjust, and then it will continue. That's why people believe that you need to invest. If you put your money in the bank and you're getting 1% Singapore is getting 0 or 0.1, and then Europe, and when the market is so high, so you need to know how to adjust, If you have problem, go and see the fund manager who are very good, okay?
Right.
Things keep on changing, keep on changing. You need to know how to adjust, You need to know how to adjust. And that's what we did. We have done a few adjustments, and which we think was right. When people are so bearish, when people, okay, you say you have problem in so and so industry, you go and analyze them. Some of those companies are very good company and very undervalued, and they are going to turn around. So that's how you make a lot of money. I think when people say crisis create problem, but will provide opportunity. That's the truth. But you must know how to do it. Your knowledge, your experience, your philosophy, I think will put you up. You can see on many of the outstanding fund manager, they outperform they not only outperform the index, they also outperform the absolute return in a big margin. That will protect your wealth. That will protect you're basically getting poorer. If the inflation come up so high, and you're putting in your saving account, why are you doing that? Especially when the interest rate is very low. Now, when the interest rate is very low, normally the market is very good. But that's where you adjust, you know, when the market price is too high, low interest rate doesn't help you. Yeah, but you need to know how to adjust your investment according to the environment.
Thank you, Dr. Tan. I think there is one last question that came in at last minute, right? And I'm going to open up to all panel speakers to do, or maybe just each one of you, just give your tips because it's quite a general one, right? So the question is, as a consultant, right, what are the relevant risks that I can convey to my clients to spark some action from them? So obviously, you know, the consultants want to know, very good to talk about all this risk, but what can they do to generate some, I don't know, sales or, you know, switching funds or what? So maybe I'll start with you, Dr. Tan, a quick.
Okay, quick one. My answer very simple. With such a low interest rate, don't put your money in the saving account. Don't put your money in the fixed deposit because the bank also can run into problem. You can see some of the European banks are facing a lot of problem. Okay,
right.
That's my answer.
That's a very good question, a good answer. Sally, any tips from you?
Yeah, not supposed to give investment advice, but I think ESG is high on the agenda, both from the return and the risk perspective.
Okay, all right. So put some money in because this is the future. Right, that's basically what you're saying. Yeah. And Suyan, any responses from you?
Well, I would say embrace technology, don't fear it. It's here to stay.
Okay. All right. Thank you very much to all the panel speakers for a very interesting session. I hope the audience have found some useful information, tips, and would be able to, you know, reach out if they want to. You know where's FIMM's website. Any questions? I think we can flow it to the speakers. So I think we are almost done on time. So if you're okay, I'll leave it back to the MC.